If you wanted to buy Bitcoin 5 years ago, you had a problem. You needed a crypto exchange account, plus a bank that would actually let you fund it. You needed a wallet. You needed to figure out custody, private keys, seed phrases, and whether the exchange holding your coins was about to blow up. For most people, that was enough friction to just not bother. Then in January 2024, the SEC approved something that changed all of that. The Spot Bitcoin ETF. Let's break down what it actually is. An ETF, or exchange-traded fund, is a basket of assets that trades on a stock exchange just like a regular stock. You buy a share, and behind the scenes, the fund holds whatever it's tracking. There are ETFs for the S&P 500, ETFs for gold, ETFs for oil. They give you exposure to an asset without having to buy and store the asset yourself. A Bitcoin ETF does exactly that for Bitcoin. You buy a share through your normal brokerage. The fund holds actual Bitcoin and stores it for you. Your share price tracks the price of Bitcoin. No exchange account. No wallet. No seed phrase. Your retirement account can hold it. Your financial advisor can hold it. It just looks like another ticker symbol on your screen. But here's where it gets interesting. Because not all Bitcoin ETFs are the same. There are two kinds. Futures. Bitcoin ETFs, which have been around since 2021, don't actually hold any Bitcoin. They hold futures contracts that bet on Bitcoin's price. Because of how futures work, these funds can drift away from the actual price over time. It's tracking the asset, but with leakage. Spot Bitcoin ETFs, the ones approved in 2024, hold real Bitcoin. Every share is backed by actual coins, sitting in cold storage with a custodian. When investors buy shares, more Bitcoin gets added to the fund to back them. The price tracks the spot price almost exactly. That distinction matters. The SEC rejected spot Bitcoin ETF applications for a decade before finally approving them. The argument was that the spot Bitcoin market was too easy to manipulate. The crypto industry argued back that futures ETFs already existed, so the logic didn't hold. Eventually, a federal court agreed, and approval followed. Today, spot Bitcoin ETFs hold over $100 billion in assets. BlackRock's IBIT alone holds more than $60 billion. Other major issuers include Fidelity, ARK Invest, and Bitwise. Most charge a fee of around 0.25% per year, which is cheap by ETF standards. The trade-off, and there is one, is custody. When you own Bitcoin through an ETF, you don't actually own any Bitcoin. You own a share of a fund that owns Bitcoin. There's an old saying in crypto, not your keys, not your coins. If you want true self-custody, an ETF can't give you that. What it gives you instead is convenience, regulation, and a tax-advantaged wrapper that fits inside a normal brokerage account. For most investors, especially those using retirement accounts or working with traditional advisors, that trade-off is worth it. For Bitcoin maximalists who want to hold their own keys, it isn't. Both positions are valid. So the next time someone tells you Bitcoin had a record day because of ETF flows, this is what they mean. Hundreds of millions of dollars moving into funds that hold real Bitcoin, connecting traditional finance directly to the spot crypto market. The same way gold ETFs reshaped the gold market in 2004, spot Bitcoin ETFs are reshaping crypto today. That's a Bitcoin ETF. We cover crypto on the days that actually matter, plus explainers like this one. Hit subscribe so you don't miss it. We'll see you next time.